Well, thanks, Jack. It's good to be here today, guys, and to be speaking to people about Forex because it's one of those things that it's kind of got a mixed relationship with the public about how people perceive it, how people feel about it. For me, it was something that I started back in 2015. I began actually trading with a community that was absolutely awful. One of these signal groups. I had no idea what I was doing. And it was kind of at that point that I came to a crossroads where I was like, you must be able to make money doing this because people do. But how do you? Because the way that it's kind of being done right now and the way that I got introduced into the industry was not a way to be a profitable trader. So what I did is I went away and began to test multiple different things that I was learning online. And through trial and error, I eventually found a very basic strategy that I'd created myself that I found worked and was reasonably consistent. Now, unlike kind of many people I did that kind of have the dream of Forex, it didn't kind of happen overnight, and it was not one of these very quick supercar Dubai experiences that you kind of see all over social media. Back when I started in 2015, there was no prop firms, which obviously for you guys that don't know what a prop firm is, they're essentially like an angel investor or a company that will give you a portion of capital from kind of 5,000 all the way up to 2 million, and they will then take a percentage of your profits once you can show them you are profitable. So therefore, it allows you to scale capital very quickly. Now, for me, that wasn't one of those things that existed back then. It was purely whatever money you had is what you traded. Um, so that was kind of a great thing that's been removed for you guys. So you can now do that. But like I said, when I started, it wasn't like that. So it was a very long journey and a journey that kind of resulted in me having to trade in a way that wouldn't be advised in nowadays because I was having to trade with larger risk to make the amount of money I would like to make. And then I kind of came to a crossroads in 2016 where sadly my partner, my wife, got really ill. And the job I was working at, it required me to either stop trading so that I could focus on looking after her or kind of give up my work and go full-time trading and make that step, which is what I did. I was kind of pushed into doing that because they kind of decided that they wanted me to leave because they essentially couldn't have someone just not being there, which makes sense, you know. So I began trading full-time in 2016, and this is my 9th year trading now. Over those years, I have traded all different styles, all different time frames. And over the last few years, I've found my most consistent and most balanced way of trading, which is a way that I see myself trading forever, which is trading the higher time frames. So the first thing we're going to speak about today, now we've kind of gone over an explanation of who I am, is the different types of trading. Now, there's three main ways that most people trade the market. Well, there's two key ways. There's a fundamental way and a technical way. So I do not trade fundamentals. Fundamentals is essentially traders that trade only on the news. So they do not look at a chart. They have no interest in what the candlesticks are saying, what the price action is saying. They look at the economic data and they will make a decision on whether they believe price will rise or fall on that currency, depending on the news that's going to be released. So if the news for the dollar is going to be positive, they believe that the dollar will rise, therefore they will buy dollar currencies or sell against opposing currencies. Now, well, that's great, and it seems kind of a very straightforward way to trade. As we all know, news and economics is extremely volatile, and therefore it's not really a way that I'd suggest to trade. Which brings us to the other style of trading, which is technical analysis. Now, what this allows you to do is read the chart, read patterns, candlesticks, price action, indicators, all sorts of different things. And this will allow you to build an image of what price is looking to do within the chart and within those time frames. So within technical analysis, there's three key ways that people trade. So you have scalping, essentially. Now, scalping is a lower time frame trading model, traded usually on the seconds or the minutes. And the idea for these guys is they are very busy throughout the day. They will be taking multiple positions multiple risks added to their accounts, and they'll be looking to get in and out in a very, very small period of time. They may be taking 5 to 20 trades a day. And obviously, with each one of those trades, they will dilute their risk to meet their risk management and their risk portfolio and their risk appetite. What that does obviously involve is a very strenuous and time-consuming style of trading, which is great if you have no life or if you want to sit on the computer all day and that's your choice. Great, but it's not for someone like me. Then we have kind of intraday trading, or what some people may call day trading. Now, day trading is when you look to take a position that will last 1, possibly 2 or 3 days sometimes, and that will be taken on almost like a mid-time frame bias. So what you'd be looking at is, what do you believe is going to happen over the next few days, the next few weeks? Then we come to swing trading. Now, swing trading is the way I trade. It is essentially waiting for the very high probable trades to take place and to set up. You may only take 3 to 5 positions, sometimes 1 or 2 positions a month. But what it allows you to do is set an area of interest, wait for that area to be met, and then simply get involved. Now, there is obviously more to it, but what it does allow you to do is have a life in and around trading. Because for myself as a mentor and a trader, one of the main things and one of the main kind of pieces of opposition that you come across is, I don't want to trade all day every day. Otherwise, you could just stay at a 9 to 5. If you want to have freedom, which is obviously why I began trading. I've now got 2 small children, 2 sons. I don't want to be glued to a chart all day. So swing trading essentially will be understanding the higher time frame. We look at what we believe is going to happen over the next couple of weeks, couple of months, and we look to get involved in a key point in the market at either a high or a low, so that we can follow the whole move. So the only way I can kind of compare it with analogy is, day traders are looking for a little slice of the pie, or a little slice of the cake. They will essentially try and get a couple of good trades to make up a slice. Then you have scalpers, and they are all day constantly going around trying to get little crumbs, and those crumbs will eventually make enough food to kind of curb their appetite. With swing trading, you're just waiting for the right opportunity to take the whole cake, and that's all you want to do. I may only trade once or twice, but essentially the returns on those 1 or 2 trades will far outweigh what could have been if I'd have been sat at the desk trading all day. So the key thing when it comes to swing trading is understanding where the market is going and where it wants to go on a higher time frame. So I'm just going to share my screen now with you guys. Can you guys see that?
Yeah, we can see that.
So essentially, when we look at a chart like so, just to curb any confusion, my candles are grey and black. Most people, when you see them, they will look like this, green and red. The reason that I don't have my candles red and green are essentially 2 reasons. Psychological kind of bias towards red and green. We're taught in the world that green is good, red is bad. Green is go, red is stop. Green is money, red is loss. Now, that's not the case, because obviously if you're in a sell trade, you'll be looking for price to go down, but the candles will be red, and therefore that will trigger something within your internal dialogue and your psychology that will make you consider essentially making a bad choice based upon a color that's triggering in your brain. Point number 2 is, when you've been looking at candles for nearly 9 years, red and green kind of burn into your eyes, and when you're sat in a dark room at night, it's not very very good to be looking at bright luminous colors, okay? But each one of these candles represents a time frame. So for each one of these candles on the daily time frame, as we can see here, they represent a day's worth of price. So each one of these candles is 1 whole day's worth of price. As you can see, when the candle's going up, they're grey. Price is moving up over that period of time, which is essentially the 6th of July to the 19th of July. So just over 2 weeks, right? Price went up non-stop. Then we've had this huge drop off, okay? My job as a trader is to understand where the market wants to go long term, number one. Number two, where is it going to move from? And number three, how can I get involved? Now, as a day trader and a swing trader, what we understand is the market will move in trends. And eventually that trend will break and you have a shift in momentum. So we may see that over this period of, say, 6 months, price eventually pushed up, pulled back to correct itself, pushed higher, pulled back to correct itself, pushed back higher, pulled back to correct itself. In turn, every single time, the highs were getting higher and the lows were getting higher also. Okay. Then we see that we made a new high. We also made a lower low, which means this level broke. And this is where we begin to see the market turn around. And what we can expect from here is to see price continue to fall. So that's a very, very basic concept. Now, the reason that the majority of people fail in the trading space is because they do not have the patience to wait for the moves in the correct place. What people are trying to do, what people are trying to do is get involved from here and get involved in buying and selling all the way up and down in this leg of price, and doing the same thing here, buying and selling here. When you understand price, you understand this is a pullback. So the only thing worthwhile doing in this phase of the market is selling, which means you can remove 50% of the risk because you understand you're only going to take one direction trades. And the same with this, I understand this low wants to make a new high, so we'd only look for buy trades here. So rather than trying to fight the momentum and fight the money from the banks and the institutions, we just try and piggyback on the back of that. If you can imagine that all of the traders in the world, on all of the platforms, in all of the brokerages, on all of the social media platforms, if we all sold everything that we had, every asset we had, put it all into our trading accounts, and we all pushed buy or sell at the same time, we would not move the market one pip. We are talking about a market and a level of volume that moves trillions of dollars every day. So the Forex market in one day moves, I mean, the stats last year around 7 trillion, which is more than the GDP of the whole of the UK over a year. So that's the kind of volume you're talking about. So you don't want to be fighting against that. It's essentially the same as driving down the wrong way of the motorway. You want to make sure you're on the right side of that road. Okay. The way we do that is by understanding swing structure. Now, just like I drew the market moving up like this and then changing, we can see that the market does that. Essentially, not in the same way that we draw it with a lovely stencil and a lovely line. It has a little bit more kind of character to it. But what you can see is you had a low, this low made a new high. We pulled back, this low was higher than this low. It made a new high as higher than this high, and so on, until this low makes a lower low than this one, and we can see that we've gone from moving up to moving down, and therefore the understanding is that this new high, which is lower than this one, will create a new low. Now, we are not reinventing the wheel here. There's people all over social media, there's people all over the internet that will make you believe that you need hundreds of indicators and hundreds of fancy lines and all sorts of markings and colors on your charts to make sense of what's happening. But market structure has been being used since Forex markets began. Richard Wyckoff, who's a very famous trader and analyst, has been using it since the early 1900s. He's wrote many books on it. Back when they used to plot the charts for paper, coffee, gold on blotted paper, and then get a ruler and draw the lines together to create what we are looking at now to understand whether the price is going up or down. So the way we do that is essentially by understanding the highs and lows of the market. So understanding that the market is pushing up and pulling back and pushing up. One of the key things that we understand in the market, and one of the first things I always teach all of my students, is the market likes to correct itself. So I always use an analogy of kind of a journey. If this is point A and the market wants to go to point B, it would be really great if the market just did this. It would be great for all of us. We'd all just buy here and make a load of money when it gets here. But that's not the case. So just like essentially when you're on a journey, if you have point A and point B, like so, and you're traveling along your journey and you get 2/3 of the way to your destination, the only problem is that you figure out you haven't got enough fuel to get the rest of the way. So what do you have to do? Well, you have to go back on yourself, even though it's against your kind of better judgment and going away from your overall goal. You have to pull back to go to the petrol station, get the fuel you need to carry on the journey. And this is why the market does this. It's refueling, it's pulling back to collect orders on the way to its destination. That's the way we kind of look at the market, and that's the way that we understand what's happening. So I had a little bit of a glitch on the screen, so I'm just refreshing it for you all. So that's the way we understand how price moves. In order for us to understand where price goes, we use something called a GAN box. It's called premium and discount pricing. So we will pull our premium and discount from our swing to swing, and this allows us to make a prediction as to where price will go. So this is where I was explaining before how we can understand how to get involved in the right side of the market. This is what we would call the premium of the leg. This is the top 50%. This bottom 50% here is discount. So taking these concepts into account, if we kind of look at an analogy of a car, for instance, you go to view a car, you want to buy a car, it's worth £10,000. You know that that is the fair market price of that vehicle. So anywhere from there or below that price would be a great place for you to buy, because you'd be getting it at a good price. It's a discount or market value. If you went to purchase a car and the price was above market value, you wouldn't be interested, because it's at a premium price. So what we do with Forex is we understand that when price is in the top 50% of a leg, the only thing that we're looking to do is sell. Because if we own the vehicle, if we own price, we want to sell our item at a premium pricing so we get the most money. So what we understand is anywhere from here, we're looking to sell. We can get involved in sell trades to here. Once we hit this 50% line, we are more than happy to just sit out and wait for buys so we can buy in the bottom 50%. So this automatically removes negativity and incorrect bias in the market, because you're not looking to buy here before the pullback is completed. Okay, so understanding this is going to save you huge amounts of time in the market, time chasing your trades, and more importantly, a huge amount of money. But it will prevent you taking poor trades in the wrong direction. We also need to understand how we can get involved in the market and where we can get involved. It's great understanding that the market will pull back into the bottom 50% usually, but being able to get involved from there is where we want to kind of escalate to the next step, because without that, the information is pointless. So we use areas in the market called supply and demand. I won't go into this in too much detail. You can find stuff out about this on YouTube. You can find out how to find them, etc. It's one of the things I teach in detail in my community. For those of you that don't know, I have a community where I teach students how to learn this strategy, profit in the markets, and eventually get prop funding. So in our community, we've got over, I believe it's over 10 million in funded traders. So there's a lot of capital, and it shows that what we do works. It's very consistent. But what we do is we automatically know the market wants to pull back into this 50% range at the bottom here. We identify the levels of interest. There's a level of interest here. This level of interest is where the fuel to continue the move is. So just like we said, both will push up, pull back, refuel, and then continue on its journey. This is where we want to try and catch that move. Our aim is to catch the move from here, back up, to make a new high. Then we just repeat this process again. So as we see, price will pull back, touch in, collect orders, and then turn around. Okay. The difference of us is, as swing traders, I waited between kind of 30 to 35 days for this pullback. So for this 35-day period, I didn't go to work. I didn't lift a finger. I did about 5 or 10 minutes worth of analysis every single day, and I knew exactly where I wanted to get into the market. Day traders and scalpers, they're getting involved in all these tiny little buy and sell moves here, trying to catch the crumbs. 2% here, 3% there, okay? Now, I won't show the entry because obviously that's something that I teach to students and something that's probably too difficult to grasp straight away for someone just watch this anyway. But the goal for us is to get involved from this area up to this swing high. We're looking to catch that move, okay? We get involved with a 15 pip stop. You can see here. So very small stop loss. So our entry was within this wick on a lower time frame, and the goal was to take it back up to this. Because what we understand about the market is on the higher time frame, this low has one job, which is to make a new high. This high has one job, which is to try and break this low. It pushes back, it fails to break the low, makes a higher low, and now this low has a job to break this high. So our understanding is this low now wants to make a new high and break this level, hence why my price, my target was here. And we can see, as we pull this along, I waited around 35 days for this trade. I then got in this trade here, waited a further 42 days to take my money. Over those 42 days, we made 30%. So if you take into consideration the average prop firm account is 100 grand, £100,000, that's a return of 30% on your capital, which is a 30% profit, so 30,000. Obviously, that would be split out over the waiting period of 35 days plus 40 days. So you're looking around 70 days, so about 2 months, just over 2 months. But that's around a £30,000 return. So, I have people in my community that have 600, 800,000. So you can imagine that one trade there would bring in 2 or 3 times their previous salary. So there's a lot of benefit in waiting and taking these high probability trades, because the main thing that I try and get into people's head is quality over quantity. If I break it down into numbers here for you guys. So let's say we have 2 traders. We have trader 1. He takes trades that are a 1 to 2 risk to reward ratio. Essentially what that means is for every 1,000 he puts in, he gets out 2,000. Okay? Which means every time he takes a trade, he's risking £1,000 on that trade. Now, as a day trader or a scalp trader, he may take, say, 30 trades per month. Which means his overall risk, his overall risk is 30%. So put that into kind of perspective. He's risked 30% in total. So if he lost every single one of his trades that month, which we hope he wouldn't, because obviously he would not be a very good trader, he would lose 30%. So 30,000 on £100 on a 100,000 account. Let's say he has a 50% strike rate. A strike rate is your success rate. How many trades you win or lose? Let's say he has a 50% strike rate. So let's say he takes, for instance, 10 trades. He loses 5. Those 5 losing trades equal minus 5%, 1% risk per trade. His winners, as we know, make 2,000 because he's risking a 1 to 2 risk to reward ratio. He's getting in and out of the market very quickly. So his winners of his 5 winners equal 10%. So he has a total of 5% profit for the month. Okay, which is good. If you've got a £100,000 account and you make £5,000 profit, most people would be very happy with that. Okay, but we have to take into account that he has risked 30% if he's taken 30 trades. In this case, he's risked 10%. Okay, so now let's look at. Zoom in there, don't that. Let's look at trader 2, someone like myself. So my risk to reward on a trade is minimum 10. But as we saw there, lots of my trades run to 20 or 30%. So let's say I take, for instance, 5 trades a month. The total risk for me is 5%. So the max loss that I will have over a monthly period is 5%. So I could lose only 5,000. Okay. I also, for instance, say have a 50% strike rate. I don't. I have a better strike rate than that, sitting around 65% over the last 24 months. But I also say take, on average, 10 trades just to make it even when we compare. Now, my losses also equal 5% because nothing changes there. I risk 1% per trade. My strike rate is 50%. I take 10 trades. If I lose 5, I lose 5%. However, my winning 5 trades are 10% each, which means I make 50% profit. So my overall profit for the month is 45%. Now, when we take this into consideration, I've risked 5% to make, 10% to make 45%. Okay, he'll be risking 5% to make 5% profit. So what we can see here is, even if this trader here, he'd have to take, he'd have to have that strike rate, and he'd have to trade multiple trades that get anywhere near my 45% profit. Every time he places a trade, he's risking 1%. So if he places 100 trades, he's risking 100% of his account. And that will give him the same return as we've got here, for risking only 5%. Okay, so the main thing to take into account is, number one, as a trader, you do not need to take more trades to make more money. It is one of the only professions in the world that you do not exchange time for money. And this is something that I come across with my students on a regular basis. They think that being more active on the charts and making more and taking more trades will result in more money at the very beginning, because they're stuck in the mentality of, I earn X amount of money per month, I need to earn more money, so therefore I exchange with my bosses more of my time to get more money in my paycheck, overtime, whatever else. Okay, that is not the case in trading. All you need to do in trading is scale your capital. So if you can do 10% a month and you have £1,000 account, if you now scale that £1,000 account and you go and get prop firm funding and you get $1 million, that 10% just became £100,000 a month. Okay, you didn't do any more work. You did exactly the same amount of work. You both took 5 trades, for instance, but the person with more money made more money. You both gave the exact same amount of hours. So it's really important to understand that with Forex, because so many people get sucked into this more is more, like more trades equal more money. And that's why these signal groups, they pump out to beginners 10, 20, 30 trades a day. But we know that if you're taking 30 trades a day and risking 1% per trade, you're risking 30% of your capital. You know, if you, let's say you have £100, you lose 30%, you've now got 70% of your money to make back, but get back up to 100%. It's going to take forever. Okay, so understanding risk and maximizing winners and reducing losses is such an important factor. Okay, it's almost like, and I always use this analogy with people, right? And they always laugh, and they always think I'm being like harsh, but we've all got those friends We've all got those friends that one's very calculated, knows what he's doing, got a good business brain. The other guy's a scatterbrain, right? Got loads of different ideas. That's this guy. Got loads of different ideas, everything going on. He wants to be involved in everything, fingers in all the pies. He comes to you and says, mate, lend me 10 grand. I've got all these businesses I want to start. Give me £10,000. Absolutely not. Am I giving this guy £10,000? Because the risk to reward is terrible. For every pound he puts in, he's only looking to get £2 out. Every £1,000 he puts in, he's looking to get £2,000 out, right? I'm not going to give the money to this guy because he's all over the place. How busy he is. Whereas this guy here knows exactly what he's doing. This is the friend that's calculated. He already runs a successful business, and he comes to you with a business plan, and he says, look, I have this business plan. It works. It's proven. It makes money over time. For every £1 I put in, I get every 1,000 I put in, the business produces £10,000. The only problem is I want to scale the business rapidly. I need another 10,000. Of course, if I had to choose, I'm going to give this guy my money. And that's the way trading is. I look at trading, and my students look at trading as a long-term investment. You're not going to get rich quick, but you can get broke really, really, really fast if you try and day trade and stuff like that, because the price moves so quickly that if you're not on it, if you're not at your computer screen, if you don't know exactly what you're doing, if you're not on top of the economic data, you're just going to be just dragged under, okay? And it's important to remember that the main thing, the main way that the industry teaches you to trade is lower time frame, okay? All of the teaching platforms out there that are provided online for free, Baby Pips, all of these companies out there that give away free trading education, they recommend day trading. Day trading has a high volume. It's important to understand that the brokers are the people that fund these education platforms. So what the broker is doing is they are training you through an online platform that's free in how to lose money. Now, the broker will then understand that everyone that comes to them is trading a certain way. Therefore, I know they're going to lose money because I've taught them incorrectly. If I've taught them incorrectly, what do I know? I know they're going to lose money. So what do I do as a broker? I bet against them. If I know that whatever you're going to do loses 80% of the time, then I'm just going to do the very opposite of what you do. And that is why the Forex industry is one of the most cutthroat, ruthless industries in the world, okay? If you look at the banking sector and the trading sector in real terms, the majority of investment bankers, traders, hedge funds, they are not trading micro data and lower time frames and in and out of the markets. What they will do is they will get in a large position and they will continue to add to that position until it changes direction, and then they get out. And what you'll find is these banks and institutions, they will make the majority of their money instead of over 12, not consistently every month for 12 months. They'll make 80 or 90% of their overall yearly profit or loss in 1 or 2 quarters. So a lot of them, for only 3 months of the year will they make money. So let's say they make 30% in January, 30% in February, 30% in March. They've made 90%. Okay, now let's say they lose for the rest of the months of the year, but their losses are low. They might eat 10% out of that. They're still 80% up for the year because they have such good risk management, okay? So anytime you're looking at trading the market, make sure you understand what phase of the market is in. If the market is pushing up like this and you can clearly see that it's getting higher at each point, and then the market starts to pull back here, buying here is a very, very poor option. Understand that this level needs to be split into 50%. Wait for the price to come down. Wait for a collection of confluences to tell you the market's going to turn around. Execute that and wait to catch that. And try and trade with the momentum. You know the momentum is in these legs. These legs are just pullbacks to trick people into getting involved. And the money is in these big moves, okay? So essentially, you can see that in the market in plain as day if you look carefully enough. We can see If you just put the GAN box on, we have a low to a high. We can see the market pulled back below 50%, moved away again, created a new high, a new low, pulled back into the bottom 50%, pushed away again, made a new high, new low, pulled back into the bottom 50%, moved away again. So that would mean that you would have a winning trade from here to here, a winning trade from here to here, a winning trade from here to here, and a winning trade from here to here. And then what happens here is you would expect the market to do exactly the same thing, pull back into the bottom 50%, but instead the market broke late last year and changed direction, like we can see here. So now what happened is it broke a low. So now we understand the market has shifted from buys being optimal to sells being optimal. So we just repeat that process again. Wait for the market to pull back. This time we're looking to sell. So where would we sell? We want to sell our items at a premium price to get the most for our money. So in this top 50%, we identify an area of interest in which the banks have orders set, which is this wick here, as we can see. The idea is now the market will dally around, just dilly-dally, till it hits this area, like so, and then it will look to do exactly what it did before, make a new low. And then just so we have this trend here, pushing up like so, this should now turn around and turn bearish. And just to kind of prove the point, it's not quite completed yet, but just to kind of to show you what we're talking about, it will come up to this level here, tap in, sellers get back involved in the market, and the goal is to continue bearish and break this low. So our goal would be for us to get in here, like so, on a lower time frame with our entry criteria, understanding that price wants to do what? Create a new low, and there we can see this is a trade of around 46%. So far, this trade would have been running for 130 days, so about four months, because we only have 5 trading days in a week. So over the last 4 months, it's been running. Let's say it takes 5 months to finally break this low, like so. That means that we made 46% over 5 months, just under 10% a month. So just under £10,000 a month if you have a £100 account, all right? For 1 day's work. Let's not forget that. You made that 46% from this 1 day's work here, and then that 1 day's work continued to pay you for the next 6 months. Whereas if you were trading, scalping or day trading, you'd be placing trades and adding risk every single day, okay? So that is why I swing trade, along with the fact that, as you probably see on Jack's social media and kind of the Mental Me page, he's got a young child too. One of the main reasons for him is not just the financial freedom and the financial wealth that comes with side hustles or being kind of financially literate in trading or Amazon FBA, but the balance that comes with it for life. Because realistically, I work maybe 1 hour a day, and then I go to the gym. I spend time with my kids, spend time with my wife. I have freedom, okay? Whereas you have to take into account, if you're a day trader, you will be trading the London session, which is essentially the main volume is 8 till 12. And then the main volume of New York is 1 till 4. So you'll be trading 9 till 12, 1 hour lunch break, and then kind of 1 till 4 in the afternoon. And that's you at your desk all day, waiting for opportunities. And if nothing happens, you don't earn any money, you didn't get paid that day, yet you spent all day at work, okay? So for me and my circumstances, swing trading is kind of a blessing, all right? So if you do have any interest in understanding how to read the markets, drop me a message on Instagram, or you can find me on the Mental Me platform. I do one-to-one lessons where we break the strategy down into 9 individual steps. So it's fully systematic. no kind of discretion needed. It's very black and white. You have to wait for these 9 steps to play out one after the other. When they do, you execute the trade. Okay, anybody can do it. I could literally teach my 6-year-old how to trade. The difference is you need to be able to be emotionally literate and strong when it comes to patience and waiting. Okay, the trading is not the difficult part. Understanding when to sit on your hands, when to be involved, when to not be involved, when to take risk, when to not take risk. Those are the things that make a trader. The actual trading strategy, there's thousands of strategies out there that work. This is not the only strategy that works. It's different horses for different courses. The only difference being is your personality may not fit those tradings, those trading strategies. So if you are the kind of person that's looking to trade, be relatively hands-free, let your positions run for a long time, make money over a longer period of time, and make large returns rather than be busy day to day, then this is something for you. So yeah, if you want to know any more, then you can always contact me. But Jack, have you got any questions for anybody?
I would just like to say, Alex, thank you so much for that. That was a real masterclass, I guess, on swing trading and trading in general. I mean, personally learned a hell of a lot from that. I really appreciate that. There have been a couple of questions. I've also put a couple of questions in myself, and Andy was asking how do you know when the price is down? So I guess how do you know here? We're obviously setting our 50%, but how do you know it's then not going to rebound from the lowest low? So if you take obviously the timestamp you were saying in October, how do you know that when it's gone back up in the beginning of 2024, how do we know that's going to come back down and create a new low?
So the simplest answer to that is we don't. You can never know. There's no way. If we all knew, then obviously we'd all be billionaires. We'd love it. However, there are kind of 2 things. You can stack confluences together, which are essentially the 9 steps that I use in
Yep.
the right. One of the very quick things is understanding order flow. So I'll go through that very quickly. If you have essentially a market that moves like this, we have an understanding that the market broke this daily structure. Therefore, because we broke a high, the market is bullish. Okay. Now, what happens is anything that fails to break this high or this low, for instance, if we had something that pulled back like this and then moved like this, we would move this high and this low like this, and this would be a new range. Okay. Now, this range here is our swing range, and this is where we would pull our buy to set our premium discount. Now, we don't just believe that market falls down and just changes. We don't just get in when it touches an area of interest. What happens is this is what we call swing structure, and then we have internal structure. So what happens is even though the candles look like they're just going bullish, within that there'll be stories and certain things that the candles do. And what we'll see is that the candles begin to turn around and chop and change from bullish to bearish within this range. As you can see, they were bearish here, then they turned bullish. But what do we know? We expect it to pull back to at least 50%. So even though they turned bullish here, we would not be looking to buy. And then we can see, obviously, the candles carry on back bearish again. They continue to fall. They turn back bullish, but yet they have not reached the bottom 50%. So we understand that buyers are not interested, okay? And price will chop and change bullish and bearish in this internal structure. This is essentially like the lane. So the car is swerving all over the lane, bad driving, but you didn't actually go out of the lanes. You stay in the lane you're in, okay? Now, the way we understand that is, how do I know this pullback is going to start to create this high and pull back? And how do I know that this low is going to be a new low and make a new high? I can never know for sure, but we have something called price action. So if we look at this break here, we understand that this was our new high. And then if I pull back to here, we can see, you see these little red and green dots? These mark internal structure. So what we can see here is we broke this low here, bearish. So we know that the market is bearish. There's a green dot there, pulls up, pushes back down again. As we can see, make another bearish break. So the market is bearish at the moment. Then we break this low here. We have another bearish break here. So at this point, we understand that both the trend and the order flow are bearish. So what would we want to do? Well, if we're looking to trade the pullback to 50%, we would need to see a change in order flow to tell us that the market is getting ready to pull back to the higher areas, like Andy said. How do we know it's going to go there? And when it gets there, how do we know it's going to go from there? Well, we have an area of interest here, which we traded from. This is back in September and started to change in October last year. We took this as a group. And what you'll see is it will go from breaking lows like this to breaking the high. And you'll see a very subtle shift in momentum. And what that will do is that will be the catalyst for the market to pull back. Now, we understand that the market is pulling back, but we must not get fooled into believing the market is bullish, because we know the main move of the market was bearish. What this is doing is this is facilitating a pullback to 50% so that the sellers can get back involved again and catch this new high. So what you should see now is you should see a shift in order flow. So again, a new bearish break, like so. And then if we break this high, price is shifted. There we are. Price then shifted from here. This time it shifted bullish. So we now understand the trend is bearish, order flow is bullish. That means that we have a good indication that it wants to pull back to 50%. We understand that there is a level of interest here it wants to pull back from. We'd look to get involved from here and only up to the 50%, because at 50% I know that sellers want to step into the market. So I take this trade from here. I then, like Andy said, would wait for the same thing that happened here to occur within this to tell me that the momentum has run out, the orders have been kicked into the market here, and this job now will be to run this low. So if we play this through, we should see the market turns bullish. 25% roughly made there. And now we should see we have this high, broke this high, here's the low. Should now break this low. There we are. So we break that low. Market wants to pull back to at least 50% of this leg. Like that. And then price should look to begin to run down to this low, like so. It's pushed up into an even higher level of interest here. You've taken a loss there if you've taken the trade, all dependent on if you've got your criteria met, obviously on the lower time frame. But you see how it shifted back bearish, and then obviously that indicates that price is looking to turn bearish again. And from there on, price continues to break lows, break lows, break lows, then it breaks this level. And you can see that happen all over the market. If you look at every single time the price changed direction, you can see here, it was bullish. How do we know the pullback's going to start? Turns bearish. Bearish, 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 bullish. That change there facilitates this move up here. Changes bearish, pullback begins, changes back bullish, new high. So essentially at the highs and lows of every single part of this market, there's certain things that happen one after the other that allow us to understand a new phase of the market is being traded. When we trade the pullback, we would only look for a 50% pullback. When we trade the impulsive move with the money, we look to gain the most out of that. So we can essentially trade both sides of the market, but only in the right areas and once prices turned around. Otherwise, you're just trading fully against the market, and it's no good for anyone. So hopefully that explains how we look for that, Andy. It's not just a case of price came into this level and I just guessed that it was going to go from there. There's a certain level, there's a certain criteria that must happen on different time frames that build a picture within here that tell me this is going to form the new high, and in turn that high wants to push down and catch this low. I mean, and you kind of predicted from here so far 540 pips. So if you look at these, if you look at the majority of traders that are posting results, 10, 20 pips is what they're kind of doing on a daily basis. Whereas you've just got over 500 pips here with a potential for nearly 700. So it's not a bad couple of months' work, all right?
Yeah. I was going to say that's incredible, right? And I think I actually personally have a couple of questions for you.
Yeah.
This strategy, obviously, this can apply to any currency, right? Obviously, you're doing euro US dollar here, but I mean, by the looks of this swing trading strategy is very much looking at, you know, what the market sentiment is at macro level, and obviously that's why we're looking on the higher time frames. I imagine you can apply this to, you know, any currency, right?
Yeah, I mean, I don't trade personally. Now, I always say to people, pairs are like cars. You can, if you've got two cars, if you and your wife have both got a car, you can get in your wife's car and drive her car pretty much problem free, right? And you can swap between the two cars day in and day out, depending on what you need to do and what the circumstances are. If, however, you work at a company which has 20 different vehicles and you're driving a different one every day, it's very hard to understand where everything is, how it drives, you know, how it steers, how it brakes, in order for you to drive that car efficiently and safely. So it's much better to understand one or two currency pairs, okay? Because all currency pairs have different characteristics. They're a bit like children. Like both my children look exactly the same, right? And it'll be for friends, girlfriends, whatever you want to relate it to. But there's certain things that one will do that the other won't do. Okay, certain things that you can say to one person that they will laugh at, and if you say the same thing to someone else, they're not going to find it funny, and you're going to be in trouble. And it's the same with currency pairs. They all move differently. The volume is different. They have different characteristics. They like to trend differently. They like to pull back to different levels. So I always believe it's better to understand one, two, or three pairs and know exactly what they're doing and be honed in on them, opposed to be trying to master multiple different ones, you know?
Yeah, 100%.
It's a bit like someone that, if I need my bathroom done, I'm going to get someone that's a plumber. If I need a kitchen fitted, I'm going to get a chippy in, right? I'm not going to get a jack of all trades in, because he's kind of all right at everything, but I want a proper job done. And it's the same with trading. You can't expect to be a elite level trader and spread yourself thin. And you'll see that a lot of traders will trade one instrument and they will know it inside out. They'll be able to tell you every move it made over the last 5 years.
100%. I think that's usually one of the red flags from signal groups is, right? I mean, they're sending you 100 different signals a day of 50 different currency pairs. So 100%, I completely agree. And the last question, I think, before we wrap up, as a swing trader, and obviously, let's say, you know, somebody here was going to go on and start trading, and they were getting multiple funded accounts with different brokers, would you be looking to enter the same trade across brokers, or would you be looking to take different trades?
So I take the trades on all of the capital. So what we have to take into account is that I only trade between 1 and 5 times on average across a year, like per month across a year, right? So averages out. Sometimes it'll be 5 or 6, sometimes once or twice a month. Each time I enter that trade, I only risk 1%. So I literally am happy to take every trade I take on all of my capital. So I have £600,000 worth of prop firm capital through 2 different brokers. Okay. And I have a software which you can readily get online. It's £20, $20 per account that you link up to it. And what that will do is it will mirror your trades onto your other accounts. So I only trade one account, but it will mirror my trades on all of my accounts. It will close it when I close it. So anything I do on the one account, it will do it on all of the accounts. So for instance,
you enter in the same trade.
yeah, I'm essentially just duplicating it hands-free, which makes it life so much easier, right?
Yeah, it gives you that extra freedom,
And
right? Because you
yeah,
are
and
following
also
the trend.
I trade for a private equity firm as well. Obviously, I don't get to keep 80% of the profits like you do at a prop firm, but it's like high seven figures. So it means that even a very small return on there. So when it's such high volume, when it's such a high account, I trade at 0.5% risk. So I lower my risk because therefore I can make the same amount of money for the investors as I would just trading a lower amount, but with half amount risk, which means over a month I may only risk 2.5% of the capital, and we're still bringing a large amount of returns. So listen, everybody trades slightly differently when it comes to risk appetite. Some people like to trade, oh, well, I don't trade that many trades every month, so therefore I'll trade 2% per trade to make up for the quiet times of the year. That's fine too. It's down to what you've tested, what you've back tested, what you feel comfortable with, and what shows. If you test something over years worth of data and the results show it works and it's safe to do, and you feel comfortable doing it, then you should do it.
Yeah, 100%. I think that's usually what trading comes down to. I think having a trading strategy that you can always fall back on, even when you feel, maybe a bit uncomfortable or a bit uncertain. Having a set trading strategy that you follow, and obviously that's your 9 principles. We've actually had one more question come in from Omar, if you don't mind. What is the minimum amount of capital you would advise starting with? And saying the market went into an unexpected pullback and it started to free fall, would you automatically set a stop loss of 5%, or would you do like a risk analysis on past trends?
So I have a set pip stop loss. So my stop loss is 15 pips, which means that if the market, once I enter a trade, moves 15 pips the wrong direction, it will take me out for a 1% loss. So it will automatically close my trade at minus 1%. So for instance, if you had £100,000 account and you took a stop loss, then it would just close at 1,000. You'd be minus £1,000. You have to set a stop loss because, just like Omar said, the market can go into free fall. So if we look at something like USD CHF, for instance, right, just a great example of why you should set a stop loss. Monthly, here we go. So you can see, oh, sorry, Euro. Yeah. So see this candle here? These big candles? This is what happens when people trade financial data. So this is like kind of a news candle. So you can even go to like a daily, right? And you'll see this candle is one whole day's worth of price. Okay. Now, for instance, if you didn't set a stop loss, this would be your whole account gone. Now, what can happen is if you trade for certain brokers, you need to make sure, obviously, number one, that the broker you trade with is regulated and that you are not accountable for slippage. Because if you'd have risked, say, 1% here with your lot size, but you hadn't set a stop loss, and this moved 200% further than your stop loss, that means that you'd have lost 200% of your account. But you don't have 200% of your account, do you? So what do you think happens? You get hit with a nice big kind of
You get liquidated, right? You lose your account.
Liquidated. You didn't close the trade quick enough, and they come and ask for your house because you owe them double the amount that you had to lose, right? So these are the kind of things that sadly cause people a lot of stress when they are trading very high leverage. They have lower amounts of money. They trade high leverage. They're gambling. They're very aggressive. The kind of people that you see that are, these very aggressive Wall Street traders and stuff. this would have ended careers, just due to the fact that, you know, if you've got £1 million trading account and suddenly not only do you lose the million, but you owe £1 million, it's game over, right? So you have to use a stop loss, right? When it comes to the other question about capital, how much would you start with? It would have been a very different question a few years ago. So around 3 or 4 years ago, I would have said, look, it's very difficult to start with anything less. You know, if you're looking to trade full time, if you take a rough calculation of 100% a year, say, let's say that you can do 100% a year. Let's say you need 40 grand to replace your job. That means that you would need £40,000 cash ready in a trading account. So if you make 100,000, 100% over that year, you replicate your salary, okay? Which obviously I understand, and it makes sense that most people want to get into trading for the financial benefits, which means they don't usually have £40,000 sat in their bank account to just stick in a trading account willy-nilly, because if they did, they wouldn't need trading, okay? So that would have been my answer a few years ago. Now, what I would say is, there's no need for you to risk any single penny of your own capital. What I'd say is go and take a free challenge or a multiple set of free challenges with prop firms. Prove to yourself that with a strategy that aligns with their rules, you can pass the challenge. Once you pass the challenge, they will give you the money. Okay, so they will give you something like 100,000, 200, 400, whatever you want. Okay, whatever you pay for, and they will just take 20% of the profits. So, for instance, if they give you 100,000, you make 100% a year, you get 80,000, they get 20,000, but you've made zero risk. Because if you pass the challenge, you even get your initial £500 or £600 back refunded, right? So that's what I'd suggest. And then everything you take from a prop firm, when you withdraw that, as much as you can, put into a personal account and build a personal pot. So if there's ever a problem with prop firms, if it ever closes down, if you ever decide that you don't want to follow their rules and you want to just go off and do your own thing, you have your own account to fall back on, I'd say. But prop firms really have opened the door to kind of taking the barrier to entry away from trading, because before you needed huge amounts, you know. I know people that started trading 10 years ago and they actually went and took out loans, or they actually used student loan to start trading with. And obviously, for some people, it didn't go so well. For some people, it went great. But that's a huge risk. So prop firms have really changed the game. So yeah, but when it comes to prop firms, be very careful. There are some not so good ones out there. I would only recommend really going with FTMO or Alpha Capital. Those are two I've used for a long time. Obviously, nothing can ever be guaranteed, but they are, you know, the kind of leaders of the industry. So you want to make sure they're a little bit more expensive to use, but you know you're going to get your money. Last thing you want to do is earn £20,000, be buzzing, and then get told you're not getting your money. You know? So that's what I'd say, buddy, to be honest with you.
That's amazing. I think I appreciate, Alex, you spending all of this time with us. I know we've gone over slightly, but that was a real masterclass. Extremely valuable. It even makes me consider, you know, trading as a side hustle as well, right? So I think it just goes to show that, you know, swing trading, especially with your strategy, Alex, is something that you could manage alongside a 9 to 5, because you are looking at sort of macro trends here. You're not doing something where you're sat at your desk, you know, in and out of trades consistently throughout the day. This definitely seems like something that, you know, people can learn and build out their own strategy if they want to tweak it slightly, and then start, you know, trading across, you know, a couple of years. And I think that's something that this strategy can do. I think it, as it says at the top, right, patient pain, motherfucker. And I think to you guys that have been on the call and maybe watching it back on the playback is, you know, I think with a strategy like this, obviously you want to get funded. If you can see where you are maybe in 3 years' time, you know, with a strategy like this, you know, it could be life changing. You could be talking about, you know, funds that Alex has been sort of pulling out, whether it's 50K a month or 100 grand a month, you're taking in profits. You've got to build that base of knowledge and sort of see it in the long term picture. Because if you do want financial freedom, you want location freedom. You know, I see Alex's Instagram every single day, and unlike most traders, he's spending time with his kids every single day, enjoying life. And I think, if it's very much something that you're after, you need to see it as a long-term plan, which Alex mentioned at the beginning of this call. So, that Alex, I really appreciate you spending time with us and taking us through this. To whoever's been sort of answering or asking questions around how you can get in touch with Alex, I will, when we upload this, I will sort of tag Alex's Instagram. So please feel free to give Alex a follow. And if you want to start working with Alex, you can start booking some one-to-one sessions in on our Mentor platform. But Alex, do you have anything you want to wrap up with? Otherwise, we'll wrap it up there.
Just say that in Forex, the kind of statistics show that 97, 96% of people fail, right? And sadly, that is the case. But the majority of people fail not because they do not have the skill set to trade. It's because they, number one, can't separate emotion, and number two, they can't be patient enough, okay? Trading is one of those things that makes you look at yourself, and if you're unwilling to accept that maybe you're not the most patient person, you need to work on that, and you need to kind of work on yourself, then it's not going to be something that you can do, okay? So you're going to learn a lot from yourself from trading. You're going to learn a lot about yourself, but it's so worth it, and it's given me a life that, I could only dream of, from being a ground worker and digging holes and putting lamppost columns in the ground 9 years ago to kind of the life I live now is unbelievable. So treat it like a marathon, not a sprint. And I think it was Warren Buffett that said, when he was asked, if what you do is so simple, why doesn't everyone do it? And his reply was, because no one wants to get rich slow. And that's why people look at Forex and think it's get rich quick. So after 3 months, when they haven't made 100 grand, they quit. When really, if they had just carried on for another 1 or 2 years, they'd be in a position where it's game changing. And once you understand it, you can scale it beyond belief. Okay, you don't need to find more products. You don't need to pay for more warehouse storage. You don't need to do anything. You literally just need to get more funds from a prop firm and do the same you've been doing. Okay, so just think of it as a marathon and not a sprint, guys. All right, and best of luck to you.
Perfect. Well, Alex, thank you so much for that. And thank you, everyone, for jumping on. Thank you, Omar, for the happy birthday. As I said, this is going to be uploaded into our community. It should be uploaded this evening. I know, Trevor, you wanted to watch it back. It'll be there tonight. So definitely watch this back. And if you want to get in touch with Alex, his Instagram it will be on there. And I think, Alex, you have a free community. So I'll make sure that that's tagged in the school community as well. So thank you, everyone, for coming on. And we'll see you next week.